myself Aditya P. Tripathi. We'll talk about absorption costing in numerical terms in today's lecture of mine. Previously, I told you about the fundamental rules which are being followed in the chapter of absorption costing. I told you the differences between marginal costing and absorption costing, along with the similarities, that what are similarities, where they are same, what is the purpose behind using marginal costing. Marginal costing deals with the internal reporting, whereas this absorption costing is being used for external reporting, or you can say you are reporting to the outsider parties. Now I'll take you to a format of statement where I'll show you the income statement as per absorption costing. I'll tell you how to go for using this statement as per absorption costing. So here we are actually showing the sales. I have to prepare a statement as per absorption costing. Sales is being written here. What we do, we deduct cost of production out of it. And when I say cost of production, it may comprise of all components of your cost sheet which relates to prime cost and works cost. So what we are taking here, we are taking raw material consumed, that whatever is total cost of raw material, we are using it here. Along with that, we are having direct labor, which was part of prime cost, variable manufacturing overheads and fixed manufacturing overheads. Now if you pay some attention here, while calculating the cost, while deducting or subtracting cost from sales, what we are doing, we are not only considering variable manufacturing overhead, but we are also considering fixed manufacturing overhead. So this is the point where absorption costing differs from that of marginal costing. In marginal costing, we will only consider variable manufacturing overhead, whereas in absorption costing, we do consider variable as well as fixed manufacturing overheads. When we aggregate all these costs, it is known as cost of goods produced. Now once cost of goods produced is calculated, what we do, we add opening stock of finished goods. Now here comes a question of how to evaluate the opening stock of finished goods. Remember, the opening stock of finished goods is coming from where? It is coming from the closing stock of previous year. So whatever was the closing stock of the previous period, that becomes the opening stock of present period or current period. So opening stock of finished goods, they are supposed to be evaluated from the information which is given in the previous year's cost sheet of prepared as per absorption costing. So what we do, we refer to the previous year's cost sheet and we value it at the previous period cost. Because at times my students are asking me, sir, why are we calculating opening stock of finished goods as per the previous period cost? It is obvious, because your opening stock to which you are considering that it belongs to current year, from where it came? It came basically from the previous year. So that is why it is this opening stock of finished good is valued at what? It is valued at previous period cost. Now once it is evaluated, what we do, whatever we are getting, after adding it to cost of goods produced, we call it cost of goods available for sale, or we can also call it cost of goods sold in approximate terms. But why I am calling that, we are calling it in approximate term, because I have to subtract closing stock of finished goods. Now closing stock of finished goods, always remember, they are valued at current period cost of production, because they belong to the present period. They are actually coming from the present cost sheet. That is why closing stock is valued at current period's cost of goods produced. Once I have added the value of opening stock and closing stock, added and subtracted, what we get cost of goods sold. Now after this, a point comes where we have to cast our eyes to identify whether into my production process I have to compare my units, my labor hours, my total working with that of budgeted hours or budgeted time. And in case suppose you find that you worked less than the budgeted hours or budgeted production, obviously there can be a case of over absorption. So either there would be over absorption of fixed overheads, fixed manufacturing cost, or there shall be under absorption of fixed manufacturing cost. If there is over absorption, that shall be subtracted. I have shown here that we are subtracting over absorption of fixed cost, whereas had it been an under absorption, we could have added. So if it is under absorption, you have to increase your cost. If it is over absorption, you have to reduce your cost. Very common understanding. It's a common sense that if it is over, make it under. If it is under, make it over. Make it the real. So if it is over absorbed, obviously you have to reduce. After that, whatever cost you are getting, you have to add selling and distribution overheads and office and administration overheads to arrive at total cost, and here you get your profit. So this is the way, my dear students, this is the way we prepare income statement as per absorption costing. So if you look at the entire preparation of income statement as per absorption costing, or statement of profitability as per absorption costing, what we are doing, we are considering variable as well as manufacturing overheads while computing total cost. Along with that, another difference here is while computing the value of opening stock and closing stock. So opening stock and closing stock, they are valued at in different ways. Opening stock is valued at previous period cost, whereas closing stock is valued at current period's cost of production, right? Now I'll tell you about the difference in profit under both techniques, that how it differs. Difference in profit under both techniques. Remember, you have to understand that, sir, at times we are getting the similar profit with the help of marginal costing and absorption costing. So how would you defend, how would you justify that profit from both the methods, they are the same, marginal costing and absorption costing? So what is the point of applying these two different techniques? See, it can happen in some situations. Now you have to first understand what are the situations in which marginal as well as absorption is going to provide you the same profit, whereas what are those circumstances where these two methods are going to give you different amount of profit. So remember, situation 1 is when your production is equal to sales. So whatever you produce, you are selling the same. You have produced 10,000 units, you have sold out 10,000 units. So practically speaking, you have neither opening stock nor closing stock. There is no inventory with you. So if there is no inventory, obviously profit in both the methods is supposed to be the same, because it is only the inventory where we differ. Because while calculating the cost of inventory, what will happen? In marginal costing, we'll only consider variable manufacturing cost, whereas while calculating the value of inventory in absorption costing, we'll take up variable as well as fixed manufacturing cost. So this is basically a point of difference. This is the point where these two methods are giving you the identical results. So if you have to, at times in exam we are asking that if your production is equal to sales, what will be the profit in marginal costing, what will be the amount of profit in absorption costing, will they differ or they will be the same? Answer is, whenever your production is equal to sales, the sales profit will be the same. But what if your production is greater than sales? If your production is greater than sales, you are producing more than what you are selling. It means it results into closing stock, it results into inventory. So that closing stock is going to be valued. So obviously, while evaluating the closing stock, marginal costing says that our cost of production is only variable manufacturing cost. So value of inventory will be lesser. Whereas in case of absorption costing, we'll take up both, and closing stock, you all know, it goes to the credit of your trading account. So what will happen in case of absorption costing? Your profit will be higher. So without solving the question, you can identify the direction of your profit, that if my production is greater than sales, at least I can say that my answer is correct, provided my profit is higher in case of absorption costing. So suppose if you are coming across a situation where your production is greater than sales and your profit in marginal costing comes to be 10,000. So remember, your profit in absorption costing should not be less than 10,000. It has to be greater than. It may be 10,500, it may be 10,200, be it 100 rupees, but difference has to be there. So when production is greater than sales, always remember profit in absorption costing shall be higher. So you know the direction of your answer. The beauty of this topic is that you know the direction of the answer. While attempting in the exam, you know that this is going to be my answer. You know the direction. You cannot know the concrete value, the exact value, but yes, you can find out that whether I'm going in the right direction or not. Now, what if your production is less than sales? The third situation. If your production is less than sales, then it will reverse. In case of marginal costing, your profit will be greater as compared to that of absorption costing. Now, at times my students are asking me, sir, why this happens? Why when production is less than sales, why my profit is greater? When your production is less than sales, what does it mean? If your production is less than sales, it means you are going to take up, you are going to exhaust, you are going to consume your opening stock as well. Otherwise, how would you sell? How would you transform that entire deal? How would you convert it into sales? Because your sales is suppose 8,000, your production is 6,000, so 2,000 shortfall will be recouped from where? Will come from where? Will come from opening stock. So practically speaking, you are eliminating the entire inventory, so your cost is going to be lesser. If your inventory is not there, and for calculating cost in marginal costing, you are saying, sir, I'll only consider it as marginal costing, will only take up variable cost, will not take fixed cost or periodic cost, then obviously in marginal costing, when your cost is less, selling price is the same, your profit will be higher. Whereas in absorption costing, it will be opposite, because you are increasing your cost by adding fixed manufacturing overheads into your total cost. So when you are increasing your cost, selling price is constant, your profit will be less. So my dear students, I just try to make you understand, I just try to give you a direction that you can come across these three situations while attempting questions of marginal and absorption costing. I'll be solving, showing you by practical problems under different situations. I'll first start with a situation when production is equal to sales, and I'll show you that profit under both the methods comes to be the same. Then I'll let you go to other two situations and show you the difference, the way profit increases in case of absorption costing when production is greater than sales, and so on. So this is what I wanted to exhibit in front of you, that when your profit is same, don't bother about that, because when your production is equal to sales, both the methods are supposed to give you the same profit. But that doesn't mean that absorption costing is going to lose its relevance. It is very much relevant, because it is being used for external reporting. So you need to understand that these different techniques can provide you different levels of profit depending upon the situation, different situations. What if your production is equal to sales, greater than sales, or less than sales? Now I'll let you go to a problem, to a numerical problem, to which I'll also provide you the solution, how to solve it. So there is a company which is giving you some information to prepare income statement under number 1, marginal costing, and number 2, it is asking you to prepare an income statement as per absorption costing. So it is asking you to prepare income statement, or you can say statement of profitability as per marginal as well as absorption costing. Now question is giving you this indication that you have to assume that all fixed overheads were apportioned to all three products on equitable basis. Equitable basis means there is an equity into apportionment of this fixed overhead, and that they have done. Now if you look at this problem, there are three products, particulars, product X, Y and Z. These three products are given to you, and sales of these three products are reported here, 32,000, 61,000 and 16,000. Along with that, they are telling you about direct material, direct wages, factory overheads, which is comprises of variable and fixed, selling overheads, variable and fixed. So they are not making a total of it. They are reporting you two categories of overheads. One is factory, another is selling overhead, and in both the categories they have fixed and variable overheads, and you have to prepare statement of profitability, or you have to ascertain the cost as per marginal costing as well as absorption costing, right? Now I'll first show you the statement of profit as per marginal costing. Now let us have a look what we are doing here. So let's have a look at this diagram where the sales is reported. Sales for product X is reported 32,000. We are subtracting variable cost out of it, which is reported in the question, because we have to first take up all variable cost. I'm just moving in the second column, so that you should understand the same has to be replicated in other two columns as well. So for product X, 32,000 is sales. We'll subtract variable cost out of it, and it comprises of direct material, which is 7,500, direct wages 9,000, and variable factory overheads, which is reported 3,900. Along with that, we have variable selling overheads also, which is 2,100. So if I aggregate the total variable cost for product X, it comes to be 22,500, right? So total sales is 32,000 for X, and total variable cost, which comprises of material, wages, variable factory overheads and variable selling overheads, and it becomes 22,500. And contribution, sales minus variable cost, will be your contribution. Contribution of product X comes to be 9,500, right? Now the same process we shall apply for or replicate for product Y and Z also. Remember, we are not taking fixed factory overheads and fixed selling overheads separately for all products. We'll club them together cause it is marginal costing. Here we have to take cost in totality. We don't take cost, fixed cost product wise. Although question has provided, cause we have to prepare the statement of profit as per marginal as well as absorption costing. So I'll tell you where we'll be using, but here for marginal costing we'll take up variable cost first. Similarly for product Y we have taken 30,000 of material cost, 9,000 wages, variable factory overheads 9,000, variable selling overheads 6,000, making a total of 54,000, and you can call it as total variable cost. Now your contribution comes to be 7,000 here. The same for Z, if you follow, you will find a contribution of rupees 4,000. If you make a total of it, the total contribution comes to 20,500 because total variable cost is 88,500, total sales is 1,09,000. Now here you are getting the total contribution, and from this you will have to subtract the total fixed cost. Remember, when I say total fixed cost, I have to take fixed factory overheads and fixed selling overheads. Both will be clubbed and you will get an amount of rupees 9,000, and you are having a profit of rupees 11,500. So this is the way we prepare statement of profitability as per marginal costing. Now here, before I proceed to absorption costing, let me tell you that what we are doing here, how it is, what kind of situation it is, whether it is situation 1 when production is equal to sales or greater than sales or less than sales. This is a situation where your production is exactly equal to sales. We assume that as per the reporting of the question that whatever you have produced, the same have been sold out. So production is equal to sales. So before attempting this question, I know that the absorption costing is also going to provide me the same profit. So my answer is known to me that if marginal costing has provided me 11,500 rupees of profit, absorption costing shall also provide me the same profit, that is 11,500. Now how do I know? Cause I am aware of this situation. There is no opening stock and there is no closing stock reporting in the question, and it is an inventory. I always repeat it time and again while discussing about marginal and absorption costing, that if there is no opening and closing stock mentioned in the question, the profit as per marginal costing and absorption costing will always remain the same. So you have to understand, my dear learners, you have to keep this thing in mind, that once you are attempting a question, first identify whether there is any question of there is any mention of opening or closing stock or not. If it is not there, by preparing marginal costing statement, you should understand the same profit you are going to get in absorption costing. Now I will show you the same computation as per absorption costing. What we'll do, we'll have 3 products, product X, Y and Z, and you are provided with the direct material. But remember, here we don't follow the format of sales minus variable cost contribution. We don't follow that because it is a kind of cost sheet where you have to show the total cost. So we start from direct material, direct wages, we make it prime cost. Even if you don't write prime cost, we don't mind because already your company must be having a cost sheet. Here what we do, we go for writing direct material, direct wages. Why I wrote prime cost? Because I assume that you are accustomed to cost sheet, and there we used to call it prime cost. Now you have to add factory overheads. If you look into the second column of product X, you can find the difference. What I was saying, the same has been implemented. Here I am not writing variable cost here and fixed cost later. What I am doing, I am writing fixed cost 3,000, variable cost 3,900, and we are making a total of it and calling it to be cost of production. So remember, you have to take up fixed as well as variable manufacturing cost because I am following absorption costing. So I have taken both fixed as well as variable manufacturing cost to arrive at cost of production. But remember, you can say the non-inventoriable, or what we call as periodic cost, that is selling overheads or office and administration overheads, they are not part of your cost of production. They are additional cost, although we are going to add it, but yes, they are non-inventoriable. While computing the cost of equity, we take COP, that is cost of production. So here what we'll do, we'll add selling overheads additionally, fixed and variable will club together 1,500 and 2,100, Total cost comes to be 27,000 for product X. Sales reported in the question is 32,000. Profit for X comes to be 5,000. The same process we shall be replicating for product Y as well as Z. Remember what we are doing while writing the factory overhead, we are taking up both, that is fixed as well as variable cost, fixed as well as variable manufacturing overhead, whereas in marginal costing we were only taking up variable manufacturing overhead, right? So if we follow the same process for calculating, product Y is giving me the profit of 4600 and product Z is giving me the profit of 1900. When I club them together, I get the profit of 11,500. And here you can compare it with the marginal costing. That marginal costing statement gave me the same profit, that is 11,500. And there is no miracle into it. I was very much aware before preparing this absorption costing statement of profit as per absorption costing. I was very much aware. So as a learner, as a examinee, you are aware that if my production is equal to sales, there is no opening or closing stock, obviously profit is supposed to be the same. Now what if in this question your examiner is asking you to give your comments? You have to give your valuable comments. So let us analyze what you would say. You would say that profit under both the methods are the same, that is 11,500. So either you follow marginal costing or you follow absorption costing, they are supposed to provide you the same quantum of profit, that is 11,500. Now what if you have to give a reason to it, why this profit is the same? You know the reason, but at times you ask me, sir, how to write? So you would write that this is because there are no opening and closing stock of finished goods or work in progress reported in this situation. So if there is no opening stock, there is no closing stock of finished goods or work in progress, obviously your profit is supposed to be the same. So while attempting the question as per absorption costing, I have let you go through situation number 1, where we have understood what if my production is equal to sales. If my production is equal to sales, profit under both the techniques, both the methods will be the same. Now we'll take up another question where it is going to change. I'll tell you about another problem. I'll let you go to another problem where the profit will change, and let us see what is there into that situation. Let us go to the problem number 2. There is a company called LK Limited. This LK Limited is selling its products at ₹3 per unit. They are reporting you the selling price, and the company is using first in first out method for valuation of inventory, FIFO, that is first in first out. And they are reporting you that there is a new fixed manufacturing overhead allocation rate which is computed every year. So every year you are computing you can say a new fixed manufacturing overhead by dividing the actual fixed manufacturing overheads cost by the actual production cost. So you are taking actual fixed manufacturing overhead cost and you are taking up the actual production units. Now the question is providing you details like this for 2 years. For first year they are reporting you the sales of 1000, second year 1200, production units 1400 and 1000. Remember, sales and production units, they are given in terms of units, not in terms of rupee. Cost is given in terms of rupee. Manufacturing variable cost 700 and 500, fixed cost 700, variable marketing cost is given 1000 and 1200, and they are reporting fixed marketing cost 400 and 400. Now my dear students, what I do when I have to attempt a question like a student, like a learner, I always take up myself as an examinee that I have to appear in the exam and solve the question. So I first of all segregate that whether there is any opening stock or closing stock in the question or not. If you look into this question, you are producing 1400 in the first year and you are selling 1000 units. Although question doesn't mention clearly that there is closing stock, but you can understand I am producing 1400 units, selling only 1000 units. So where the 400 has gone? 400 is there in closing stock. Now this closing stock will go into the opening stock. Obviously it will be opening stock, right? So here in this question for the first year, production is greater than sales. So what will happen? It will result into the closing stock or opening stock, and obviously your profit in absorption costing will be higher than that of profit under marginal costing. So I know the direction of the answer. So I have to first establish what will be the direction of my answer. Manufacturing cost is given, fixed cost is given, variable cost is given. Now let us solve. They are asking you to prepare the statement as per absorption costing and variable costing, and also asking you to comment on the reasons for difference in profit. Now let us have a look at this calculation. What I have done, I have first gone for computing the opening stock and closing stock. In the year 1, production is 1400 units, sales is 1000, so difference is 400, it is closing stock. The question comes how to calculate closing stock. We'll take up the total cost. That is total manufacturing cost, which comprises of fixed as well as variable, which comes to be 1400 divided by 1400, 1 rupees per unit, and if I multiply it by a number of units, I'll come to know about the cost of closing stock as per absorption costing, because in absorption costing we take up both the cost, whereas in marginal costing I'll only take up variable manufacturing cost, and variable manufacturing cost comes to be 700 rupees as reported in the question. I'll divide it by total number of units 1400, it comes 50 paisa per unit. Now this 50 paisa per unit will be multiplied to 400 and will come to know about the closing stock rupees 200. So you can find it here that the same closing stock, when I'm valuing it, when it is evaluated at absorption costing, value comes to be 400, whereas at as per marginal costing it is 200 rupees. The same I'll do for second year, but remember in second year the closing stock of previous year will become opening stock. Second year again you are selling 1200 units and producing 1000 units, so you are ending up with a closing stock of 200. Process of calculating closing stock and opening stock is the same. Now we'll go for calculating as per variable costing or marginal costing. So take up only variable cost. Sales, we have 1000 units, selling price is 3 rupees per unit, so 3000, and here it is 1200 units, 1200 into 3, 3600 units. So we have taken variable manufacturing cost, we have added opening stock, there was no opening stock in first year. We will deduct closing stock, value I have shown you the way we have calculated. Then whatever we get is known as cost of goods sold. We have to add variable marketing cost, total variable cost will come, and then sales minus total variable cost, that is 3000 minus 1500 will be your contribution, that is 1500. And from this I'll deduct fixed manufacturing and administration cost, which comes to be 1100, and profit for year 1 is 400. The same process I'll follow for the second year, and it is resulting towards a profit of rupees 700 in year 2. So in year 2 you are getting a profit of 700, whereas in first year you are getting a profit of 400 as per marginal costing, or it is also called as variable costing. See, I am not elaborating it much because I know that you understand what is marginal costing and the way we deal with marginal costing. I shall devote some more time on absorption costing statement. So here the profit is 400 and 700. Now let us see what happens when we go for preparing it as per absorption costing. We take up manufacturing cost. Here we don't start with the sales, we take up manufacturing cost, variable cost is given, fixed cost is given. Remember, for manufacturing cost we have to take up both variable as well as fixed. So unlike marginal costing, here what we do, we take up the total manufacturing cost, fixed as well as variable. So 700 and 700, it becomes 1400, that is my manufacturing cost. I'll add opening stock, there is no value. Cost of goods available for sale is 1400, because the total manufacturing, which is equal to total manufacturing cost. I have to subtract closing stock. Now while calculating closing stock, I told you previously in the working note that this closing stock is valued by considering both the cost, that is variable as well as fixed manufacturing cost, which is 1400 here. So 1400 is divided by 1400 units, and we got the value of 1 rupees per unit. Multiplied it by 400 units, we got a value of 400 rupees. Cost of goods sold is here. Now remember, you can see, as I told you previously, that you have to take up marketing cost, you have to take up other than manufacturing cost, whatever is there will not be part of your cost of goods sold. And the same we are doing here, we are applying it here. Marketing cost, fixed as well as variable, both are written here, and then we got to know about the total cost 2400, sales is 3000, and profit here is 600. Remember, this profit is supposed to be greater than that of what you have got in marginal costing, which is there. In year 2, when you compute, your profit is again 640 rupees. So what is different here when we go for preparing statement of profit as per absorption costing? That is, point number 1 is, while considering the cost of manufacturing, we have taken both variable as well as fixed. And second point of difference is while computing your value of opening and closing stock. Now question as it has demanded, what are the reasons for difference in profit? You would write in the year 1 profit under absorption costing is higher at rupees 600 in relation to rupees 400 in marginal costing. I told you direction of answer is known to you, and reason you would report closing stock is more than that of opening stock. Whereas in the year 2 profit under marginal costing, it is higher at rupees 700 as compared to that of rupees 640 in absorption costing, and reason you would say opening stock is more than that of closing stock. So my dear learners, in this way I have told you about two situations under which how to deal with these two methods of cost estimation, that is marginal costing as well as absorption costing. I hope you must have understood how to deal with the situation of when production is equal to sales, when production is greater than sales. You understood. We have demonstrated how to calculate it. I hope you must have understood and enjoyed today's lecture of mine. Thank you so much.